we said that there are a few sets of rules using which we do our accounting. Previously, the ones that we follow previously they were called IAS International Accounting Standards, and now they have been the new ones that are issued. They are issued under the same International Accounting Standards. The International Accounting Standard Board. There is one which issues these standards. It has been renamed, and the accounting standards which are now issued, they are called financial reporting standards. Okay, so what happens is that over the period of time we try to evolve those standards. That board, it tries to evolve those standards to give a better representation. So for example, previously we had, I believe, IAS 16, which was the accounting standard for revenue, international accounting standard, IAS 16. Now I believe it has been replaced with IFRS 16 or 17, I'm not sure, but that's the new accounting, that's the new standard for reporting the revenues. So the same one, previous one was IAS 16, and when they had the need to replace it, for example, for inventory, I believe it's still IAS 2 which is under operation. The valuation for inventory, it's done as per the principles of IAS 2. Okay, it hasn't yet been repealed, and a corresponding IFRS been issued in its place. It's still the old IAS which is still intact. Other than IASs, IAS, I think it allows you to use another set of rules for accounting if you have any local rules, as long as those rules they do not contradict what's written in the financial reporting standards. Okay, so for example, in Pakistan, we have got Companies Act. Companies Act is the law which governs the affairs of different companies in business. Have you reached that stage, that chapter where you discuss different legal forms of business? So you say that there are sole proprietors, you say there are partnerships, and then there are private limited companies, public limited companies. Have you reached that part yet or not? All right, all right, all right. Oh, oh, all right, all right. So you'd get to that part. So Companies Act, how does it come into play? The Companies Act, it tells me how the different affairs of the businesses, especially companies, they would be governed. Now, the financial reporting, that is also one of the issues in the companies. So how to go about that? It suggests a certain format in which the financial statements they have to be prepared. First of all, it acknowledges that the financial statements which would be prepared by the companies, they would be as per IFRSs or IASs, not any other standard. The other thing it says is it suggests a few formats, and those formats, since they do not run contrary to what the IFRSs suggest, that is why we can follow both, and we can say that these financial statements they have been prepared both as per IFRS and as per Companies Act. Acha. So that was the legal framework that a business would use to prepare the financial statements. The next thing is there are certain concepts which underlie the preparation of the financial statements. So, for example, the historical cost concept. If I bought a building for my business, let's say for how much would be a building worth? Let's say $1 million, some building place, let's say it was in a relatively decent place, so $1 million, I bought this building for the business. I bought this building, and over the period of time we would soon learn the concept of depreciation later on in the upcoming chapters. The concept of depreciation is that once you start using a non-current asset, it would lose its value over its life, right? If you buy a car, after 1 year the value of the car won't be the same as at the start of the year when you bought it, right? So now the thing is that in the normal course of business, non-current assets they would depreciate. Acha, one thing. At the end of 1 year, at the end of year one, let's say the building, its historical cost was $1 million. It was bought for that. Yet the market value it has increased a bit. Let's say the market value of the building is $1.2 million. So what should I value this building at? The historical cost or the new market value? It should be accounted for at the historical cost. ठीक है जी. Usually the value that we'll use for the assets is historical cost. For non-current assets, there are certain conditions in which we are allowed to follow the revaluation model as well. Acha, other than non-current assets, if I take example of inventory. Okay, so let's say my business is resale or trading of the same boutique example that we have been discussing for the classes since start. Um, let's say you bought a suit for $700, and now you can resell this suit for $1,300, right? What would be the value for which you would represent this suit in your books? You haven't sold it yet. You bought it for 700. You're going to resell it for 1,300. Should it be valued at 700 or 1,300? It should be valued at 700. Why? Because the underlying assumption or the underlying principle is that initially when we have the asset, the first value that we'll assign it, or the value that it will keep on getting assigned, is the historical cost, unless there are some extraordinary circumstances which would make us value at some other value. Okay. Acha ji. So that was the historical cost concept. The next thing is money measurement concept. Acha ji, money measurement concept is that only the transactions which can be, or only the events whose financial impact can be calculated, only they are the ones which would be represented in the financial statements, others wouldn't be. So we discussed that example earlier on. Let's say you are the owner of the business, and for this week you have been coming in really happy. This is an event that does not have any monetarily measurable output that we can calculate and show. So this event, it wouldn't get reflected in the financial statements of the business. However, if you are happy and as a result you increase the salaries of your employees, this is something that can be monetarily measured. Hence, it would be represented in the financial statements. So this is the money measurement concept. Got it? Acha ji. Another concept is business entity concept. What's business entity concept? The business and the owners of the business, they're two separate entities. So for example, if I'm doing accounting for my academy, I won't bring my personal finances to it. Personal finances to it in the sense that, for example, obviously I started the business and I might have allocated some initial capital to it, and that's the capital that has been allocated to the business. Now that has become the money, and the things that I allocated to the academy, those have become the assets of the academy. Now if I carry out some personal expense in personal life, it wouldn't get reflected in the financial statements of the academy. The business, it has got its own, it exists as a separate entity from the owners who own it. So for example, if you are incurring some let's say travel expense with your family, it wouldn't get reflected in the financial statements of the business. Okay. Similarly, if you are incurring, let's say somebody they gave you a gift, it wouldn't be a revenue for the business. For the business, the revenue would be the things that the business is earning in its own capacity, or somebody is donating to the business, or some asset that you're bringing to the business. That's the only time it would come in the financial statements of the business. Otherwise, your personal transactions, they wouldn't get reflected in the financial statements of the business. That's the business entity concept. Acha. Sometimes this is also referred to as separate entity concept. The next thing is what we call the dual aspect. Acha, let me in fact refer to your Cambridge book and use the terms which have been used over there. Just a second, please. Mm, Trial balance. There was a chapter on trial balance, income statement, accounting principles, 86. 86. ठीक है जी. ठीक है. अच्छा. ठीक है. Then there is this concept of duality we have discussed. It means that every transaction, it would have two impacts. And how we record those two impacts? Those two impacts, they are recorded. They are recorded as debit and credit. It wouldn't be every transaction, every business transaction, it would have at least two impacts. So what are the examples of two impacts that we have studied? For example, your revenue would increase, and as a result some asset would increase. Either you'd have cash or bank which is increasing, or some accounts receivable which is increasing. Similarly, if your liabilities increase, it would mean that it would have another impact. It could be that an expense has increased because of which the liabilities have increased. So, for example, you have incurred an expense and told the person that you'd pay them later. So that way, the expenses and liabilities could increase. Or it could be if liabilities is increasing, there is some asset which is increasing. So you bought some goods for the business or some asset for the business, and you told the person you were buying this from that you'd pay them later on. So every transaction in the business, no matter what, it would have at least two impacts. अच्छा जी, ठीक है. There is this time interval concept which is mentioned over here. Time interval concept is that for what period of time are you preparing the financial statements? Usually, the businesses they prepare. अच्छा, so the businesses, why do they prepare the financial statements in the first place? One could be for their own use, and the other is that these are prepared for the legal requirements on the businesses. So for example, companies, they are legally bound to prepare their financial statements and submit them to relevant authorities. Acha. Then companies, how often should they prepare those financial statements? That has also been mentioned. So, for example, the local law here in Pakistan, it says that public limited companies, they would prepare their financial statements at least once every quarter. Okay, that's one thing. Then every half year, they should have a limited review of the financial statements by the auditors. And every full year, at the end of every accounting year, they should have their financial statements fully audited in full detail by the auditors of the business. So they have to prepare their financial statements four times a year. For the two quarters, there are limited numbers. Then for the half year, there is a certain addition of detail that's there in the financial statements. And then for at the end of full year, full accounting year, there is full-fledged detailed financial statements which are prepared. Acha, this, then let me see if all the concepts they are covered over here. Acha, hmm, most of them are stability of currency. ठीक है जी, ठीक है. Let's go up a bit. Acha, then another underlying concept for the financial statements is that of going concern. What does going concern mean? Every business is assumed a going concern unless there are circumstances to prove to the contrary. You'd ask, what's a going concern? A going concern is that the business, in its normal course, it would not cease to exist within 1 year. The definition, the exact definition, I think it says for foreseeable future, and for foreseeable future, we usually mean for 1 year. So for the next 1 year, there are no circumstances in the business which show us to tell that the business it would cease to exist, nor is there any intention on part of owners of the business that they are going to wind this business up. Do you get it? So I know that 1 year from now, the business it would continue in operation. There aren't any circumstances which would mandate the business to close down, nor is there intention of the owners of the business to shut this business down within 1 year. That is what going concern is. ठीक है जी. So the financial statements they are prepared with the presumption of going concern. Another underlying concept for the financial statements, it is that of consistency. What is consistency? Consistency means that financial policies that a business has adopted, the accounting policies that a business is using, these policies they are going to be applied consistently over a period of time. To give you a few examples, for example, later on we learned that there are two methods to value inventory. One method is to use the concept FIFO, first in, first out. So for example, where your inventory, it is in such identifiable manner that you can identify the items, you would uh, so the boutique example wouldn't be useful over here. Let's say you sell, chips, french fries. Okay, so if you're selling french fries, the assumption would be that the potatoes you bought first, they are the ones you'd be selling first, and at the end the potatoes that would remain in your inventory would be the ones that you have bought the last. Okay, another way to value inventory is you say that no, I'm not going to value my inventory like that. I'm going to calculate a weighted average cost. I'll see the inventory which have been bought first, I'll see the inventory which has been bought later on, and inventory which has been bought even later on, and I'll calculate an average value, and based on that average value I will calculate the value of remaining units for the closing inventory. These are two different policies. Okay, now the business, if it is using the policy of FIFO, it should consistently keep on using that policy. It shouldn't switch to average cost method unless there is some compelling reason to do that. Okay, similarly a business, we'd soon learn that there are different methods of depreciation. For example, there is straight line, for example there is reducing balance method. If a business is using, let's say, straight line method for depreciation, unless there are circumstances that mandate or that have a compelling reason to change the method of depreciation, they wouldn't do that. They would apply this policy, whatever method they have adopted for any class of assets. They would use that method consistently over a period of time. It wouldn't be that one year they switch to this method, the other year they switch to a different method, and so on. Don't worry about the details of the things that I have mentioned. For example, what's straight line and what's reducing balance, or what's, for example, FIFO and what's average cost. We'll learn those things later on when the time comes, when we get to those topics. As of now, I just wanted to give you an example of what consistency would mean. Acha, the next concept is that of prudence. Prudence, obviously, simply an English word. समझदारी को कहते हैं, अकलमंदी को कहते हैं prudence. So, what would the prudence it would mean in the context of accounting? In the context of accounting, it means that being a prudent person, a business would record all the expenses that they foresee that they would incur and which relate to the current period. So, for example, I know that related to current activity of this year, an expense it's going to arise. I'm going to record that expense. But if I see that some income, it could be related to this period, but I'm not yet sure about whether that income I will earn that or not, I'm not going to record that income. So for expenses, we are a bit lenient in recording the expenses. As for revenue, we are a little bit more strict in when we get to actually record the revenue for the business. So we record the revenue for the business when we are virtually certain that yes, we will earn this revenue. For expenses, as soon as there is reasonable circumstances to believe that this expense it will be incurred, we record that expense. So in a way, you can say that expected expenses are recorded, but expected income is not recorded until it's actually earned. That's the concept of prudence. Acha, you'd have some examples over here. You could read those later on. Acha, then there is this concept of accrual, which you might have got an idea of by now. Uh, Accrual, the opposite, it's easy to understand the concept of accrual when we know the opposite of it, which is cash-based transaction. So in a cash-based model, which we perhaps follow in our daily lives, what we do is uh, we record an expense when we actually pay for something, and we record income for something when we actually receive money, right? I receive money, I've earned this money, I've paid some amount, I've incurred an expense. Whereas for business, you might have noticed that it's not actually the flow of money which necessitates the recording of an expense or income, it's actually whether the event has happened or not. So for example, at the end of the month, even though I haven't even received the bill of the electricity, yet I know I have incurred this expense, so I have to record it. Okay. Similarly, it could be any other. So any expense for which the payment has been deferred, yet the expense has been incurred, we have to record that expense as per the accrual concept. Similarly, for income, no matter if I haven't received money for it, as long as I've sold the good or service and I've earned the revenue, I'm going to record it. So for example, I sell goods to someone and they say that they'll pay me a month or two later. Fine, I'll record the income because I have earned this income. Okay. And even though the payment has been deferred, so it could be, for example, let's say 31st December is your closing period. Okay. And you sold goods in December for which you would receive payments in January. Now, would you record this revenue or not? Obviously, you would record it because income it has been earned. Only the payment has been deferred. So this income it has to be recorded in the financial statements. Separate determination for each asset and liability would be we would be calculating that it's actually telling you to say that usually the general concept is that in accounting we do not knock things off. So for example, if there is a liability and there is an asset, so I can't show the reduced value of assets and liability by saying that I've reduced the value of assets and I've reduced the value of liabilities as well. Assets, they have to be recorded at the full amount. The liabilities, I cannot do the knocking off. Okay, that uh, I knock this asset off with this liability because they are seemingly on the other ends of the balance sheet. Are you getting this point, or is it confusing? So for example, I say that I have receivable of 10,000 from Mr. A, and similarly, I have payable of 10,000 to Mr. X. So I say I can reduce my debtors and I can reduce my payables by 10,000 matching amount. So I just reduce the assets and liabilities both by this amount. This I can't do. Okay. Similarly, the separate assets, they have to be shown separately. I can't merge the two classes of assets as one. So, for example, I can't show, let's say, the debtors and inventory together, the other receivables and debtors together. For example, debtors are something else, other receivables are something else. So I can't club the prepaid expenses with the debtors of the business. They both have to be recorded and presented separately in the financial statements. Okay. The next concept is substance over form. Substance over form is that it's full. I mean, if the full form of this phrase is accounting substance over legal form. So I haven't yet read the new leasing standards, but it used to be the way. For example, if I buy any asset on lease, let's say financial lease, this asset it would remain with me or it would become my property at the end of lease term. So for example, I get a car through bank financing. Okay, so this car, when I get it on lease, if you ever see the documents of any leased asset, on its document it shows the name of the financier. So, for example, my brother he got a car on lease. The documents of his car they would show the name of the bank which had financed that car. Okay, and not his name. Even though my brother is the one who has been using that car for all the time, and he's practically the owner of the car. But so now, what happens over here in the books? It shows that this car is the property of the bank. Practically, my brother is the owner of the car. So, who should show this car as his asset? Can my brother, if he prepares his personal financial statements, can he show this asset as his personal asset? Yes, he can, and he should, because accounting substance it takes precedence over legal form. Whatever the legal form might be, the financial substance of this transaction is that this person he owns this asset, not the financier of this transaction. Okay, so that's accounting substance over legal form. Acha ji, other than that, there is this concept of materiality. the financial statements, they are usually prepared with the assumption and with the declaration that there is no material error in the financial statements. Acha ji, what is material? Material is any amount that is so big that if a change by that amount happens in the financial statements, it would bother the stakeholders of the business. Okay. So for different businesses, they define their materiality in different terms. So for example, even while doing the auditing of different entities, you have to see that, let's say there is one entity which has a revenue of 250 million. So for example, we audited National Refinery Limited sometime back. Their annual revenue was 250 billion. 250 अरब उनका एक साल का रेवेन्यू था. And there was this other entity that we audited, GSK. Their revenue was around 25 billion. So for both businesses, what's material is different. So for example, to any of the two businesses, if I go and tell them that your financial statements are wrong because I think there is some amount which is different by 10,000 from my calculation, they'd both say, what are you talking about? We are doing the business over here in billions and you are bringing us errors of 10,000. I mean, this is something so small, it's immaterial to us. Okay, such calculation differences. So the financial statements, they are prepared with the presumption that the financial statements, they would be materially correct and there are no material misstatements in the financial statements. अच्छा जी, stability of currency, accounting concepts in action. Acha, let me check with the other book if there is anything else mentioned. There is this concept of matching. The financial statements, it would be that, for example, if I am, so I discussed a few cases where the financial statements, they would be prepared for less than a year. So for example, at the financial statements that a public limited company is supposed to prepare at the 6 month interval, the half year financial statements, in those financial statements they would present revenues of 6 months, right? Along with those revenues of 6 months, it can't be that they present revenues are for 6 months but the expenses, they are for 5 months. They can't do that. The revenue and the expenses, their period should match. If you're presenting revenue for 1 year, present expenses for 1 year as well. If you're presenting revenues for 9 months, present expenses for 9 months, and so on. Similarly, also the usually it's mentioned the date for the income statement, that for which period are we calculating. So for example, if I am calculating the income and expense for a year which has ended on 31st December, usually the case is that my statement of financial position, it would also be to reflect the assets and liabilities at the end of that period. You'd rarely or perhaps never see a case where the income is for the year ending 31st December 2020, whereas the statement of financial position is on, let's say, 31st March 2022. Okay, so these are the things that financial statements, they are prepared. There is this matching concept that incomes and expenses, they are drawn or they are calculated and shown for the same period of accounting. अच्छा जी. हम्म, ठीक है. This is it for the verbal concepts. नया टॉपिक